This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 15, 2026, and this is the London session. Now, let's get into it. Markets are bracing for a volatile session as the Fear and Greed Index plunges to 14 out of 100, painting a picture of pure investor anxiety. We are seeing a massive divergence right now. Spot dollar-yen is holding firm at 162.1425, while CFTC data reveals leveraged funds have piled into yen longs with a staggering 91,779 contract surge. The question isn't just what the central banks will do today, it's whether the carry trade is about to snap. Two major central bank decisions dominate the immediate horizon. First, the Bank of Canada releases its rate decision today at 14:00 UTC. This is critical for dollar CAD, which is currently trading at 1.4046, hovering dangerously close to its 5-day low of 1.40395. A dovish surprise here could see dollar spike higher, but we also have to watch the broader risk tone. Second, the European Central Bank meets tomorrow, July 16th, at 13:15 UTC. Euro-dollar is currently sitting at 1.1438, trapped in a tight range between 1.13776 and 1.14624. The market is waiting for the ECB to provide direction on the euro's trajectory amid this global risk-off sentiment. Apex, how do these two events frame the broader risk profile?
They frame a classic flight to quality scenario, with the BOC decision coming while the Fear and Greed Index is at 14, essentially maximum fear. We aren't looking for nuanced policy tweaks. We are looking for a catalyst that forces capital out of risky assets like RC and Canadian dollar and back into the dollar and gold. The ECB meeting tomorrow will likely reinforce the euro's weakness unless there is a sudden hawkish shark. But today's BOC decision is the immediate trigger for dollar CAD liquidity.
Let's look at the broader snapshot. We have a confirmed fearful regime with the VIX up 2.13 points to 17.16. Gold is trading at 4,032.55, holding its ground near the 4,000 psychological level despite a 0.51% daily drop. Meanwhile, dollar-yen is at 162.1425, down slightly on the day, but still near recent highs. The yield curve is flattened at a 10-year 2-year spread of just 0.42 percentage points, with the 10-year at 4.58% and the 2-year at 4.18%. This flattening usually precedes safe haven bidding. Pulse, walk us through what this sentiment data tells us about the current macro landscape. It tells us that inflation rigidity is keeping the Fed on hold. The Fed funds rate is stuck at 3.63%, and core PCE is still running hot at 3.41%. Even though real GDP is cooling to 2.9%, the labor market hasn't collapsed yet. Non-farm payrolls are still positive at 57K. So, the market isn't pricing a recession yet, but it is pricing a hard landing scenario. That's why the Fear and Greed Index has risen from 12 to 14 in just 7 days. Investors are pulling back from risk because they know the central banks can't cut rates without reigniting that sticky 3.46% CPI print. This creates a vacuum where dollar becomes the default liquidity sink. And that liquidity sink is being tested by geopolitical noise. Let's look at the headlines moving the needle. First, U.S. military strikes Iran again, and crude oil futures settled at $79.60, up $0.26 or 0.33% as tankers are disabled in the Gulf. This is directly impacting oil and risk appetite. How does this hit our currency desk? CIPHER, what are you seeing in the flows?
I'm seeing a clear rotation out of commodity currencies. Look at dollar CAD. It's down 0.5% to 1.4046, but the positioning tells a different story. Leveraged funds are short Canadian dollar by 85,957 contracts. That's a massive bearish skew on the loonie. As oil ticks up and tensions rise, those Canadian dollar shorts are getting squeezed or are accelerating because the risk premium on holding Canadian dollar has vanished. It's not just about the BOC decision anymore. It's about capital fleeing the Canadian dollar entirely due to the geopolitical spillover.
So the Canadian dollar is taking the hit from both the BOC uncertainty and the oil/geopolitics combo. What about the other side of the ledger? We've got headlines about Trump says he appreciates gesture of goodwill by Iran and former Fed official sentenced to 38 months in prison, lied about information sharing with China. Does the political noise affect the dollar's status as a haven right now?
The political noise is secondary to the structural risk. The sentencing of a former Fed official is domestic legal drama, but the Iran headlines are triggering a genuine fear response. I'm watching the VIX expand to 17.16. When you combine a flat yield curve with active military engagements in the Gulf, you get a liquidity trap. The goodwill gestures don't stop the tanker disruptions. My concern is that the dollar-yen level at 162.1425 is artificial. We are seeing spot strength while futures are screaming for a yen rally. That discrepancy is where the risk lies, not in the politics, but in the disconnect between spot price and institutional intent.
Let's dive deep into dollar-yen. It's at 162.1425, down 0.3% on the day. But critically, it is holding just below its 5-day high of 162.488. We have this huge contradiction. Spot is strong, but CFTC data shows leveraged funds added 91,779 yen longs. Grid, walk us through the technical structure. Is this a healthy hold or a failing pattern?
Technically, it looks like a bullish flag formation, but it's fragile. The price has failed to breach the 161.8 area multiple times, establishing a rigid floor around that level. Right now at 162.1425, it's sitting comfortably inside the 5-day range of 161.2825 to 162.488. There is no breakdown yet, however. The fact that it hasn't pushed above 162.488 despite the fear sentiment suggests exhaustion. The market is consolidating, not expanding. If we lose 161.8, the technical profile flips from a hold to a breakdown channel.
But Grid, you're ignoring the timing. That 91,779 contract surge in yen longs isn't just noise, it's a loaded gun. The current price of 162.1425 is essentially a liquidity trap. Institutions aren't buying yen spot, they are building hedges in futures. Once spot dips toward 161.8, those 91,779 longs will start covering. And the velocity of the move will be non-linear. You're calling it a flag, I'm calling it a coiled spring.
And that coiling spring is dangerous because the VIX is rising. At 17.16, volatility is expanding. Usually when VIX goes up and dollar-yen stays high, it means the market is confused about where the safe haven is. Is it the yen or the dollar? With the Iran tensions, some flows are going to gold, which is at 4,032.55, and others are staying in dollar. The danger is that when the 161.8 support breaks, it won't be a gentle slide to 161.28. It'll be a cascade. The minus 0.3% daily drop we see now is just the calm before the liquidity hunt.
I have to jump in here on the macro backdrop. You're all focusing on the technicals and the COT data, but remember the yield curve. The 10-year 2-year spread is at 0.42 pp. That is incredibly flat. In a flat curve environment, carry trades become expensive to hold. The reason dollar-yen is still high is because the US rate differential is still king, but that differential is shrinking relative to the risk. The 91,779 yen longs are reacting to that flattening curve. They know the dollar is vulnerable to a growth scare. The spot price is lagging the fundamental truth. The carry trade is mathematically unsustainable at these yields if the curve continues to flatten.
Fair point on the curve, but I stand by the 161.8 level. Until that specific horizontal support breaks, the breakdown thesis is premature. The data shows price holding above that level. I'd rather wait for the confirmation of the break than bet against the trend based solely on futures positioning.
Waiting for confirmation is why you get caught in the squeeze. The 91,779 contracts mean that when 161.8 breaks, the move is instantaneous. By the time grid sees the break, the trade is over.
So we have a standoff. Grid sees a valid floor at 161.8. CIPHER sees a spring-loaded exit at that same level. SPECTER warns of VIX-fueled volatility. Where is the actual liquidity pool?
The liquidity is at 161.28, the 5-day low. That's where the stops are. If we sweep that, the 91,779 longs activate fully. Until then, it's a holding pattern.
Let's pivot to gold. Gold is at 4,032.55, down 0.51% on the day. We saw it reject off 4,062.25 earlier and settle here. It's sitting right above the psychological 4,000 mark. Grid, what does the chart say about this 4,000 level?
The 4,000 level is acting as a magnet, not necessarily a floor yet. We're in a 5-day channel from 3,983.56 low to 4,134.98 high. Currently at 4,032.55, we are in the lower third of that range. The rejection from 4,062.25 was sharp. If we lose 4,000, the next structural support is the 5-day low of 3,983.56. Technically, it looks like we are testing the lower bound of a consolidation box. Volume isn't exploding yet, which means buyers are passive, not aggressive.
Passive buyers are exactly what I'm seeing. Leveraged funds are net long, but they aren't adding aggressively here. They are waiting for the geopolitical premium to solidify. The 91,779 yen longs and the 85,957 Canadian dollar shorts are competing with gold for safe haven capital. Gold is winning against Canadian dollar, but losing ground against the broader dollar index strength. The 0.51% drop suggests profit-taking after the initial geopolitical spike.
That profit-taking is masking the real risk. You're talking about passive buyers, but look at the VIX at 17.16. When volatility expands like this, correlations break down. Gold often falls in the short term during a risk-off panic because everyone sells liquid assets to raise cash. The fact that gold is down 0.51% while the fear and greed index is at 14 suggests that cash dollar is still king. If the VIX spikes past 18.91, the 5-day high, gold could easily wick down to 3,983.56 quickly as margin calls force liquidations across the board.
And don't forget the inflation data. Core PCE at 3.41% is supposed to be a bull case for gold as an inflation hedge. But right now, the fear trade is overriding the inflation trade. Investors are scared of the growth slowdown signaled by the flat yield curve, not the inflation itself. So gold is being sold alongside risk assets, waiting for the Fed to signal a pivot. Until then, 4,032.55 is a vulnerable spot. So gold is caught between geopolitical bid and cash demand liquidity. The 4,000 level is the line in the sand.
Precisely, 4,000 is the pivot. A close below it opens the door to 3,983.56. A hold keeps us in the 3,983-4,134 range.
Finally, let's look at dollar CAD. It's at 1.4046, down 0.5%. It is literally seconds away from breaching its 5-day low of 1.40395. The BOC decision is imminent. Pulse, you mentioned earlier that the US dollar has a structural advantage. Why is Canadian dollar under such pressure? Because the BOC is walking a tightrope. With USDJPY at 3.46% and the Fed funds rate at 3.63%, the US has room to keep rates higher for longer. Canada is facing slower growth. The 85,957 contract short in Canadian dollar by leveraged funds reflects this. The market expects the BOC to be cautious, perhaps even dovish, to support the slowing economy. If the BOC doesn't give a strong enough hawkish reassurance, dollar CAD will blow through 1.40395 immediately.
And it's not just the BOC. Remember the 85,957 Canadian dollar short? That's concentrated positioning. If the BOC statement is ambiguous, those shorts will rush to exit, pushing the price higher. But if the BOC cuts or hints at cuts, the upside could be explosive. We are at the edge of the cliff.
I'm worried about the contagion effect. If dollar-CAD breaks 1.40395, it triggers stops in Aussie dollar and Kiwi dollar as well. The 1.2016 AUDJPY level is vulnerable. This isn't isolated to Canada. It's a general risk currency unwind. The 14/100 fear index confirms that capital is leaving Aussie, Canadian dollar, and Kiwi en masse.
Technically, the compression in dollar-CAD is extreme. Being 0.00065 pips away from the 5-day low means we are in a binary state. Either it bounces off 1.40395 with a strong buy wall, or it sweeps the low and extends. Given the headline risk of oil in Iran, I wouldn't rule out a quick sweep of 1.40395 before finding a true bottom.
Let's tie this together. Pulse highlighted the macro pressure on Canadian dollar due to the US rate differential and sticky inflation. Grid identified that dollar-CAD is technically poised to sweep the 1.40395 low, while SPECTER warned that this sweep will trigger a broader risk-off cascade, affecting Aussie and Kiwi. On dollar-yen, Grid argued for the resilience of the 161.8 floor, but CIPHER countered that the 91,779 yen longs make that floor a liquidity trap ready to explode. And for gold, SPECTER noted that the rising VIX poses a liquidation risk to the 4,000 support despite the geopolitical bid. The consensus is clear. Volatility is expanding and liquidity is thinning in the majors.
To recap, we are watching a high-stakes session where dollar-yen teeters on the edge of a carry trade unwind, gold tests the 4,000 psychological floor amidst rising VIX, and dollar-CAD hangs by a thread ahead of the BOC decision. Keep your eyes on the 161.8 level for dollar-yen and the 1.40395 level for dollar-CAD. Tomorrow, the ECB provides the next clue for euro-dollar. Stay sharp. This has been the ShadowQuant Forex edition after hours. Check your risk parameters and monitor the levels. Next time. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.